All right, well, hello everyone, and welcome to our webinar today. Thanks for joining us. We're going to be tackling secondaries investing, going from an overview of the sector and to a deep dive of risk screening and the role that AI can play. Before we dive in, I'm just going to hand it over to our speakers, Sylvain and Jessica, so they can introduce themselves.
Thank you very much, Megan. I'll start if that's okay. Jessica, I'm CEO and co-founder of SESAMm, based out of Paris. SESAMm is a firm specializing in controversy insights and exclusions on private assets. We're a team of around 100 people, and we work with many private equity firms, secondaries investors, and LPs. And very delighted to join this webinar with you, Jessica.
Thanks so much for having me, Sylvain and Megan. So, hi, everybody. Jessica Huang. I'm a managing director and the ESG lead for both private equity and secondaries at Ares. Ares is a multi-asset alternatives firm. We manage about, well, over 600 billion in AUM across credit, real estate, infrastructure, direct private equity, as well as secondaries. And so in my role specifically, I really help with the integration of ESG considerations into the investment process in a way that's, investment decision useful and responsive to our LPs. For today's conversation, I'll be wearing my secondaries hat. And our secondaries business, specifically at Ares, spans over $40 billion of assets. I think of ourselves as a mini Ares because we have four verticals as well. So we have credit secondaries, real estate, infrastructure, and private equity secondaries as well.
Thanks a lot, Jessica. And yeah, happy to set a bit of the context for the conversation. First of all, I really wanted to thank you, Jessica, Margot as well, and the Aris management team for your willingness to share your experience and the partnership with SESAMm and to discuss this exciting topic of secondaries investment. As we all know, I think it's a booming market. There are a lot of new entrants, but there are also a lot of strong established households like Aris. And I've compiled a few stats just for everyone's sake to see how the market is evolving. So the market has grown by a factor of three since 2019. Just in 1 year from 24 to 25, it grew by around 50%. And it sits at around 230 billion at the moment. And it's estimated that secondaries now represent around 5% of all global private equity assets. Um, and as we know, with Jessica, Aris Management and the team, secondaries present unique difficulties and challenges when it comes to data availability, speed in the market. And so today, the goal is to discuss some of these challenges, as well as how technology and AI help in this context. And I'll leave it maybe to you, Jessica, as the expert, to give us a better overview of the secondaries market, how things work, and the differences that exist in that market.
Yeah, definitely. Before I started to lead the ESG program for secondaries, I did not know much about the secondaries asset class. I think a lot of people think of the secondaries strategies as similar to a fund of funds, and there definitely are a lot of similarities. But in the most simplest terms, a secondaries transaction is really the purchasing of an existing private market interest rather than underwriting something that's completely new. And so I think when you think about traditional fund of funds, you're usually still deploying into new primary funds and secondaries. While you can do some of that in your strategies, it's mostly buying existing fund assets from an LP or a GP. And when people talk about secondaries, they really think about it in two main types of transactions. It's those LP-led transactions, the GP-leds. But I think even in the GP-led space, I would kind of further distinguish the transactions. So I kind of think of it as three main buckets. So the first is LP-led transactions. This is really where secondary started. This is where a GP is buying existing fund interests from an LP. And often when you're buying this interest, it's actually across a multitude of funds. So you're basically buying that LP out of their existing investments in whatever funds they want to exit. Um, the second type of transaction, which has been growing a lot more, is GP-led continuation funds. So this is where the sponsor themselves want to continue to hold an asset, And oftentimes we're going to structure a continuation fund that holds one asset, just a few number of assets. Um, and this is where we're seeing a lot of the growth in the secondary space. And then the third type of transaction is probably the most complex one. They're structured solutions. They can take a lot of different forms, but really you're providing capital to a GP, um, or providing capital for them to fund a new fund. But that investment is then collateralized by other funds and other assets. So secondaries, just as an asset class, is pretty varied. The types of transactions that occur, the concentration of assets are different in those types of transactions. The visibility, as Sylvain was mentioning, the visibility into the underlying assets, the data challenges, all of that exists in the secondary space.
And as I went through the statistics on the market, I saw that actually now with the growth of continuation funds, there's quite an even distribution between GP-led transactions and LP-led transaction, around 115 billion on both sides, which was probably not the case a few years ago.
Yeah.
Um, and it'd be great to understand a bit the process in secondaries, especially the ESG, the diligence work, and diligence work just in general, and how that may vary by transaction type.
Yeah. So yeah, as you mentioned, the ESG diligence work really it's going to be different based off of the transaction type because you have different kind of information sets for those transaction types. In secondaries, the most high level way of thinking about how diligence happens is you have two layers of diligence. First is you have to diligence the GP themselves. So you're kicking the tires on the GP that you'll be investing in. You want to make sure that you're investing in GPs that'll be good stewards of your capital. But then at the same time, you also want to diligence the underlying assets of the funds or the deal. Um, I would say in those LP-led deals, the diligence is going to be about screening a lot of those underlying exposures to just get a general understanding of what you're taking on. Because in these LP-led deals, you could be talking about hundreds of underlying positions, or in the space of private credit secondaries, you could be talking about 1,000 plus. And so in that sense, you're just trying to understand what are those general exposures of those assets that you're buying, and are you buying any sort of bad eggs? In GP-led continuation funds, on the other hand, where you're diligencing just a single asset or maybe a few assets, you're going to go a lot deeper. Um, and definitely, if you're doing a single asset continuation fund, you're going to spend more time diligencing the underlying asset than you are even the GP, because really what your exposure is going to be that one underlying asset. And so in that case, the ESG diligence is going to feel a lot more similar to just direct private equity. But I do feel like the data availability that we struggle with in the secondary side is really in those LP-led deals. Um, those transactions can be really quick. Those transactions, you're just getting a name, a geography, um, the sector, and based off of like limited information and limited time, you have to do some sort of assessment of the risk of those underlying assets. So inherently in secondaries, a lot of this is just a best efforts process, based off of what information you have.
That makes a lot of sense, and that seems like quite a challenge, especially in these large transactions. It'd be great to have your view on the growth of secondaries and potentially evolving LP expectations in that space as well.
Yeah. As you noted, because interest in secondaries has just grown so much, their secondaries is just now becoming a more important part of our clients' portfolios, of investors' portfolios. And as that's happening, our LP conversations are getting a bit more sophisticated and complex. I always say that it feels like secondaries was sort of the last frontier for ESG integration. And so, 4+ years ago, LPs really didn't expect much from an ESG perspective. But now, I think in these conversations, LPs are really holding secondaries to more of a similar bar to direct investments. So, for example, we've had LPs asking us for Article 8 funds in secondaries. And I think maybe the biggest development that I've been seeing is that LP side letter negotiations, it's really been evolving to focus a lot more on very specific restrictions and opt-outs that apply on a look-through basis, so really looking at the underlying asset. Um, and these types of requests can be really tricky because, as I mentioned, for LP-led deals, when you're looking at hundreds of assets, and I don't think I even mentioned this, but LP-led deals are often even an auction process. So that means as an investor, you got to act pretty fast. So you're acting really fast with a limited amount of time to do diligence on just a very, very large pool of assets. And so for us to do that type of assessment for our LPs, we really had to rely on technology. You can't really do a manual assessment of 1,000 names or even a couple hundred names. Um, and so, at Ares, we had been using a provider in this space for a few years to do sort of web-based scraping, so that we could understand, what are our exposures. But one of the limitations of that provider was that they were only screening when that asset already matched an existing name in their database. So if they've already covered the name, they will tell us, what business involvement, what controversies they're finding. But that's a big constraint because in the secondary space, you're investing in all these smaller private market names that aren't going to be mapped into a central database. And that's when, Sylvain, we reached out to you and your team to really help us think through how do we solve this problem. We were basically looking to do screening on the fly and in a very short amount of time without much data, right? We're sending you hundreds of names with just the domicile and the sector. And I feel like I've asked you this question many times, Sylvain, and I still don't really know how to explain it, but how is SESAMm able to actually identify and screen those large sets of assets efficiently with that limited information? Because when we kind of looked out there, there wasn't that much available for us that could work really for what we needed in secondaries.
And it's a good question, and we really appreciate the collaboration with your team. Also, I think it's been a very constructive exercise to get you with that solution, to be able to screen for a lot of more exotic companies as well that may not be covered by other providers. And I'm happy to dive into the technology a bit more just to explain how this is done at SESAMm. So the SESAMM's core expertise is really in private markets. So we have a data lake of billions and billions of documents, around 30 billion documents. That includes company website, that includes premium news, that includes NGO websites and the like, so as to be able to find relevant information. And the important thing here is that it screens also for local contents, has around 4 million sources, and screens for 100 languages approximately. And so that gives us access to information on companies that are not tracked anywhere else. And that's the first layer of just having the right information that is quite critical in that use case where you don't have time to prepare a specific data set. It needs to be available off the shelf in order to find the right information. And then we have a second process that is around identifying companies, categorizing risks, identifying controversies, identifying specific business exposures. And in that part, we leverage a lot of AI, which we train based on our analyst methodologies. So we have a team of ESG analysts, and Jessica and Margaret have collaborated quite a bit with them through our account management team. And they are the ones in charge of defining how to identify the right company, but most importantly, how do we then identify the right type of risk, including specific thresholds of exclusions and like. And so based on that, we are able to derive a number of different use cases. One concrete use case is related to monitoring. So finding daily controversy alerts on companies, having the ability to check information on any company. And so that's part more of on the what we call the monitoring solution. But interestingly, we also build a stack of AI agent infrastructure on top of this to be able to automatically screen for companies directly from the data lake and from external sources and add business exclusions to them. And I'll show a few examples directly of this to walk you through the product elements of that. So should be okay. So it's typically the stack of AI agents, and we develop a lot of use cases with clients or based on market opportunities there. And we have a number of use cases here for agents that are called screening. So screening agents, their objective is typically we have a list of companies. So typically an LP-led transaction, and there are hundreds of different companies that need to be screened. There may be quite a fuzzy identification of the company themselves. So there is a need actually to disambiguate, find the right companies, make sure that it's part of a specific group of interests, so as to see whether there's exposure also at the holding level and the like. And based on that, we're then able to compute all of the different analytics. And again, it needs to happen relatively fast because the number of underlying companies can be high. So it should be executed both on 10 companies and 100 or 200, 500 companies as quickly as possible to match client timelines. And so the outputs from the screening process is typically a list of potential involvement in controversial activities as well as major controversies, oftentimes related to UN Global Compact violations. So here, a typical example, a company name that was provided and then linked to our unique identifiers is ACE Cash Express. And so we're screening against a number of categories, both a set of default categories that we have for all clients, as well as some custom categories, which we develop specifically for clients, such as for the RST. So here we're looking for exposure to adult and violent content, fossil fuels and nuclear, gambling and betting. And we have a match on predatory lending, where there is a significant involvement in that space, which has been targeted, and the thresholds have been defined with the team so as to match the specific expectations there in terms of what could be considered critical involvement. The most important part of this is to be able to justify this and to really provide an audit track to clients. And so here we have all of the underlying sources which reference the issues related to that involvement in predatory lending. We have a summary at a high level, which describe the reason for this categorization as potentially significant involvement in that activity. And we then have a very detailed analysis of all of the findings related to this. So as you can see, both from the perspective of what the company is actually doing, which is providing payday loans, as well as with regards to the issues that they are confronted with, both with regards to fraud allegations and consumer feedback, as well as regulatory issues in some cases, we're able to have a very clear overview of the potential issues that emerge on the company. And this is really meant to accelerate the decision-making process. So it does not replace the interpretation and the data analysis that the team is doing, but it significantly accelerates everything because there is an initial flag that can then be reviewed, as well as a lot of detailed findings that are provided. And a topic on this is oftentimes on what should be detected. And one key topic that a lot of our clients have is related to UN Global Compact violation. And I know that's also a topic for you. And so we have this ability to screen specifically for severe human rights, environmental rights violation. But inside our monitoring platform, we actually also have a module that is specifically dedicated to UNGC classification. And I have an overview here because right now we're getting a lot of requests related to Iran and Hormuz, Suez Canal, and the like. So this is typically a portfolio view where clients are able to screen all of the assets that they hold already and have a look at the exposures to potential UNGC violations, as well as enter any additional topics of interest, which can be very important for high impact events such as wars. So right here we have the entities, both companies and institutions that are most exposed to Iran, Hormuz, Suez Canal, those that are exposed to potential violations of the UN Global Compact, as well as the filtering of all of the detailed events. So here we can see each individual event and its link to the Iran conflict at the moment. And we can see a lot of companies and projects emerging, such as Bushehr Nuclear Power Plant, for example, as well as governments and different NGOs that are exposed to the conflict as well. And so this is related more to the specific topic of UN Global Compact assessment. And the last thing is, as described by Jessica, not all transactions require very high volumes of checks. And so there's another module in the platform, which is called reports. And so we do this for ESG, but as well for commercial due diligence, legal due diligence, and the like. And here the client simply provides a specific company name and identification, whether it's an ID, a website, or a description of the company's activities, and then receives a full report which is more helpful for these deep dive transactions when there is a need to really understand the asset with a lot of depth. And so here, as an example, we ran a report on a company called Prince Global Group Limited, which has been linked to sanctions and links to criminal organizations, potential forced labor scams as well. And so this example is an automated 20-page report generated in less than 15 minutes, which really helps company highlight the key issues that have emerged on the assets themselves. So that's another way to leverage technology and AI agents in order to continue to deep dive into the companies. And the goal is always, it's really to save time as well as to save money, so that emerging risks are quickly and accurately identified, and that nothing falls through the cracks. And so we're really trying to enable this growth of the secondaries markets with tools that enable to do more transaction more quickly without sacrificing on the process and while actually reinforcing these processes. So hopefully that covers the topics in terms of how that actually works.
That was great. I guess and you touched upon this a bit, but I think one of the things that's really tough in this space is that when we're doing these screens, it does require judgment. Um, and so for SESAMm, how is judgment being overlaid when you're identifying these assets? Because sometimes we're asking you for revenue thresholds, and that's not based off of publicly available information, especially when it's like 5% revenue threshold, or even for, severe controversies, there's a judgment in terms of like what is really considered a UNGC violation, because it also just depends on the severity of the event and the type of the event, which is not always black and white. So curious how you guys think about that.
Yeah, definitely. And it's an important topic. And the objective is always to do as well as a human being in the initial part of the analysis. And that means the limitation is publicly available data. And so, and sometimes there are judgment calls that needs to be done by the AI agents, but they need to be as accurate and relying on the same type of clues that a human analyst would leverage. And so UNGC is also a good example of that because it involves really the same processes. First, we always have our methodology team define the framework, align the categories of risk, make sure that we understand that framework well. So for the UNGC, looking at the 10 different principles, how they are very precisely defined, and then sharing that feedback with the data science team so that we can implement a model that really is fine-tuned for corresponding to these specific principles and doesn't do just a direct match with our standard categories of risk, which would be a bit too fuzzy in many cases. The second thing is defining what we call severity on the controversy side, or severity in terms of potential violations of the UN Global Compact, so high risk event or potential violator or watch list event or low risk event. And so again, in that case, we need to do first establishing the methodology. So what's considered severe, and that can be very, very complex. For example, for human rights violation, there's a notion of the number of stakeholders that are impacted, and whether that's more of a local event or something that happens internationally, whether it's direct or indirect, does it sit in the supply chain or does it sit with the company itself? And so all of these criteria have to be defined as roles, but that's these types of roles are the same that we would provide to our human team of analysts, actually for a QA on the alerts themselves. And we can then train the system. So we're going to do fine tuning on the machine learning model in order to make sure that it's able to really recognize this with a very professional view on that. And then importantly, we have to kind of backtest that or at least do a statistical analysis because there is a lot of sensitivity to the distribution of that data. And especially for UN Global Compact, if we were to flag 20% of all assets as violators or potential violators of the UN Global Compact, that would actually be very, very critical. And so it needs to also match the distribution that is expected in the market in order to make sure that only really critical events are flagged as potential violator. And UNGC violation, like the dataset is heavily skewed towards low risk because it's a very strong view to indicate that an event is a potential violation of the UN Global Compact. So there's a lot of data science work that goes into this. because you need to normalize these data sets in order to make sure that we respect that skewed distribution that is the reality of what the market is expecting and the reality of events themselves. And it's really the same for thresholds, is defining the methodology, providing the right threshold and the definition for the types of clues that can be given to the system. So for example, if we identify on the company's website that they define their main product suite as corresponding to payday loans, for example, that we mentioned before, then that's an interesting view that this could cross a threshold of over 5% in terms of the
Mhm.
company's activities. But in addition to that, we're going to look at all of the company's reports, any
Mhm.
financial information that is made publicly available across a number of databases in order to justify the information. And the last thing is there's really a continuous human in the loop feedback. So we see AI as a way to automate a lot of the processes, but you still need a bit of supervision on this. And we have a team of analysts that does a lot of QA on critical events and the like to make sure that we continue to provide that feedback to the system. And there are so many like strange edge cases that
Yeah.
appear that it is a never-ending process and a very
Yeah.
important one that also builds an important proprietary data set for us to continue to leverage in the future.
Makes sense.
And it'd be great from your perspective to understand now that we've seen the technical process, and hopefully I haven't done something too deep, but understand how the output is actually used in practice in your own workflows.
Yeah, I mean, I think you already sort of said it where the output of the AI screening is not a conclusion, right? It's not the investment conclusion. At the end of the day, we have to own our own investment decisions. But really, the idea here is that when we get the results from SESAMm, it really helps us then identify where we just prioritize our time and where we spend more time just doing additional digging. And so, I think we think of it as really just a prompt for further review. And there's going to be times where we override the flag because it's totally a judgment call. But I think, what's happening is instead of needing to screen, let's say, 300 or 500 or 200 companies at once, we're now screening 10. We're screening 15. We're screening 5. And it just becomes manageable from our side. So in terms of like the actual process that we do at Aries, when we get the results from SESAMm, Margot, my team member, and I will review any of those flagged assets. And we double check all the sources, we read the articles, we do some of our own digging and analysis, maybe going even beyond the links that were provided. And then we then make a human decision and we make a recommendation to our deal team in terms of what we think does this asset really warrant a flag, yes or no? And then they kind of do the final review and they make the final decision. So we have kind of multiple layers of checks. But I feel like what we built is a workflow that handles the nuances of secondaries pretty well. I mean, we're dealing with massive scale, we're dealing with imperfect information and time pressure. And so I think what we've built here, while it's not ever going to be perfect, it's definitely improved our comprehensiveness, it's improved our accuracy, and it's improved our speed.
That's great to hear, and thanks for the feedback as well, Jessica. And a question as well is how you're thinking at Aris also about broader AI use cases in ESG diligence or beyond. And I'm definitely going to take a few notes on this to see if we can help in the future. But it would be really great to understand the broader perspective there.
Yeah, and I don't think I'll say anything too interesting because I'm sure everybody who's in similar seats are thinking the same things. But I think just generally AI is just becoming a standard tool for us in all aspects of ESG diligence. And not even wearing my secondaries hat, but my direct PE hat, it can help a lot in doing those actually in-depth diligence, right? Because I think where AI helps is not when you're kind of screening a lot of assets, but when you have a lot of information on one asset, it's helping to synthesize and analyze and distill all that information so that it becomes a bit more digestible. And I think similar to how we use SESAMm, whatever AI outputs we get in ESG diligence, you don't take it for exactly what it is. There's always a human overlay. But I think, certain parts of our businesses, we're finding it pretty helpful, like on our credit business, where, the volume of transactions that's happening, AI is helping a lot. And then I think in the secondary space where I'm going to be interested in following and seeing where AI can continue to support is on the data side. I think one of the other trends that we're seeing in the LP space is that we're starting to get a few more requests for underlying ESG data for those underlying assets, which is very, very hard to collect and to come by. And I think that's where AI could be an interesting tool to see if we can start to estimate or fill in the gaps. In particular, I think for GHG emissions.
Yeah, estimates is a hot topic. I'm gonna make a note on this one. We should discuss in a few more
Well,
months
then,
for sure.
I mean, I guess like one of the things we talk about, and every time we talk, you always tell us the new things you're working on. So, is there anything else new that you're working on your side that you think is relevant to the secondary space or just broadly in the ESG space?
Yeah, there's a lot happening right now, and our team is continuing to develop new products, both agents as well as improvements on the monitoring platform to serve all clients. So the first thing that is, of course, of interest with Eris is new and custom exclusions. So they are both based on client requests as well as regulatory changes. And so right now, for example, we have the first draft for SFDR 2.0, which implies quite a few specific exclusions. And there are still some decisions to be made on some excluded activities related to coal mining, for example, and the like. And so we're following that very, very closely, both on the regulatory side. I'm actually part of the board there at AMF for the Sustainable Finance Commission, because we really need to understand what are the exclusions that are going to be mandatory as quickly as possible for SFDR 2.0. And then we also rely on client feedback for specific exclusion thresholds and the like that may apply as part of custom LP exclusion requirements. So this is always an important element. There's also the notion of new frameworks. So currently we do UNGC. Our framework is also aligned with OECD, but we sometimes get requests for ILO, UNGP, and other frameworks, including more local ones across countries. And so we think there may be a need for additional flags across a new set of frameworks. And we also have then like new agents. So you were mentioning Article 8 funds, for example. We launched a beta version of our good governance report, which is also a screening exercise where we specifically assess the credibility and risk related to governments for Article 8 funds. And we've heard a lot in the market actually from private equity investors that they didn't necessarily dare launch an Article 8 fund because of that requirement, which created a lot of manual work. So if we can contribute to this and help firms launch fund by providing an AI-augmented workflow, we think that's really a net positive for investors. And there are also a lot of use cases that are not sustainability related. So SESAMm works a lot with supply chain experts, with legal teams. So a lot of law firms working with private equity firms are clients. So we've launched also that beta version of the legal report. Commercial due diligence credits is also a very important topic across their client base. And so we have the architecture to regularly launch new agent. And also we're always looking for new use cases that emerge from clients because they are the expert. They know the workflow and they know where is the pain. That's really where the need comes from oftentimes. There's also continuous work just on coverage for monitoring. So we cover around 5 million assets off the shelf. We just announced coverage also of 250,000 infrastructure projects, but it is never enough. And so we continue to add millions of companies every year and also do more and more on demand because clients come with very exotic portfolios. It's important to be able to address that very quickly. And the last thing is, I think more specific to the technology space, but MCP is top of mind right now. So this new protocol for communication with AI agents. So we currently have API, Databricks, S3, SFTP, but we're getting more and more demand for MCP servers. And we think that's also going to change a bit the business model in the data world because more based on requests and specific calls. So this is an important item for the product team as well as from a strategic perspective. And it's something that we're going to launch this year as well. And so hopefully you'll find information embedded into a number of systems and being consumed also by external agents over time.
That's great. I don't think I actually realized the work that you did outside of sustainability, so good to know.
It's an interesting space. Yeah, what we mentioned around disruptions of supply chains right now, these topics really come to us a lot. And we work with very good partners in the space, such as Sayari, for example, which is a supply chain mapping expert. So we can provide a lot of relevant data on top of these types of solutions.
Great.
All right, so I think we're about ready to jump into questions, if I'm right. Please don't hesitate, everyone, to continue to add your questions to the chat. We'll get through them as we can for as much time as we have. To get started, I think, Jessica, first question from you. Are you doing ESG diligence the same way across different secondary strategies?
I guess yes and no, and I touched upon this a little bit. I think what's consistent is the idea of doing diligence at the GP level and then the underlying asset level. That's kind of consistent across how you're always going to do ESG diligence. But I think similar to how diligence is going to look different for direct investments, depending on the asset class, what you look at for real estate secondaries, credit secondaries, private equity secondaries, infrastructure secondaries is going to be quite different. So I think that is just consistent with the nuances of the asset class itself. But then I think, and I think I mentioned this too, is that in credit secondaries in particular, though, both even on just like GP led, but in particular on the LP led side, this is where you're going to have the most diversified portfolios and also where you're going to have the least amount of information, right? In credit side, you're already, as a direct investor, you're already kind of arm's length away from some of the information. When credit secondaries, you're really going to be like multiple arm's lengths away from the information. And so I think where we the way we do diligence for credit secondaries is just it has to be a little bit different. Whereas in private equity, we're going to have a lot more information. We can kick the tires a lot more. Um, and then I think, oh, I didn't even talk about real estate. In real estate, when we do any sort of screening, or if you're going to be doing a look through in real estate, you're not looking at the underlying assets, actually, you're looking at the tenants. So that's a different layer of screening that we would also be applying. So that screening process also looks quite different.
All right, great. Thank you. We have another question. I think, Sylvain, this is probably for you. How long does it take to create one of the reports? And how much customization can be done?
Yeah, it very much depends on the number of companies, so number of lines. So you can think of it as yeah, a few tens of seconds per individual company. And we really need that time in order to gather all of the right insights and generate the output. So oftentimes it would take a few minutes to a few hours for a standard transaction. And we've had cases where it's 1,000 plus lines, where it can take up to 10 hours, for example, or 12 hours to generate output. Um, and we've improved that process quite a bit. So this has accelerated over time, but there is a limit in terms of the speed that can be applied, because otherwise at some point we would sacrifice on quality and we would not screen everything that needs to be screened. So usually that timeline matches very well with the requirements on the secondaries team, and matches with the requirement that exists oftentimes, which is a 24, 48 hours turnaround time on their side. So on executing on the transaction, with regards to the auction and the like.
All right, excellent. So I think just one or two more questions. This one is for Jess, I think. What are some of the most common opt-outs that you get from LPs?
Yeah, I think across LPs, the most common is still, and probably no surprise, coal and fossil fuel related. In Europe, weapons continues, in particular, controversial weapons continues to be requested consistently. And then in the US, tobacco is still a very common request. I think after those four, it kind of becomes a long tail of so many other items, but you see things like gambling, adult entertainment, private prisons, predatory lending. And while those topics can be pretty similar, like the themes can be quite similar across the LPs, the exact wording, the threshold, right? Like the types of involvement is so different, right? Some people are going to care just about producers, others are going to want producers and distributors. So it gets pretty nuanced. And I know Sylvain and team, you guys have been great in helping us, I guess, curate exactly the types of exclusions and opt-outs that we need for our different LPs.
Yeah, and we've seen a lot of diversity, and not specifically with Aris, but with other clients as well in the secondary space. So sometimes it's really exclusions that are um, related also to the conviction of the team itself or the mandate that they have. For example, pure exclusion of crypto assets related businesses, for example, or sometimes entire industries where it's not necessarily controversial in any way, but that specific fund feels that they do not have the necessary expertise or do not want to have exposure to that sector. So yeah, we've positioned this more and more as not just exclusion, but really business involvement screening,
Hmm.
because oftentimes it's not even necessarily a negative. It just becomes a conviction and the perspective of the fund on what they want to do and what they don't want to do. So we've seen that expanding quite significantly over time.
All right, great. And I think just one last question based on the timing. So it says, do you ever have to say no to LP requests? I think this must be for Jessica.
Um, yes, so I would say it's more that we want to educate our LPs on what's realistic and practical. I think you just want to be clear. You want to be clear about what can be done on best efforts, never kind of overstating the access that you have to information or the position on some of these things. And I think in secondaries, a lot of times, for these LP-led deals, you're really inheriting just a book of assets. And so sometimes you have to take the bad with the good. And so I think with LPs that have very, very stringent opt-outs, it's an education to tell them, hey, there's going to be certain large deals that maybe you would miss out on. And so it's really up to the LP then to make that decision about what makes sense for them. And for some, these opt-outs are stringent, they can't budge, and it's just the values that they hold. And that's we'll do everything we can then. And for others, they kind of understand and they understand the nuances and secondaries and they'll tweak the language a bit to kind of fit their needs.
All right. Thank you. I think we're gonna have to wrap it up. We're running out of time here, but thank you very much, Jessica and Sylvan, for your time and your discussion.
Thanks again.
Thanks so
Thanks
much.
again, Jessica and Margot. Thanks to the AS management team, and we're very glad this is helping you save time and that you're able to bear the load of all of these transactions that are coming your way and the growth of the secondaries market. So thanks again for the collaboration and for your time.
Now, of course, we're so happy with the partnership. So thanks for the time.
Thank you. Have a great day.